We look at the declines on the Shanghai Composite once again today, this after the index closed down more than 20% just in January. Is it too early to call a bottom then? And doesn't this raise the question of when will the PBOC come in with further easing to kind of prop up these markets?
Well, when you talk about the Shanghai Composite, you have to remember what you're talking about. And that is an extremely immature stock market dominated, 99.5% by retail investors. So, I think the thing is not to look into day-to-day volatility because, I think that's relatively futile. And I think that, when investors in Hong Kong realise they need to stop looking, intraday for their moves from Shanghai, we might get some stability. I think what you probably want to look at is what the economy is doing. The PMI out this morning was a little under 50, so manufacturing is still relatively weak. But we would expect services still to be above 50 to be expanding. So, overall economic activity is not very strong in China, but it's very divergent between services and manufacturing.
Charlie, good morning. You mentioned it yourself. I mean, we have seen these falling prices. We've seen overcapacity also in key sectors like steel and energy. And many people are thinking that that's going to be around for quite some time, this measure of overcapacity. How do you, as somebody who sits precisely with Chinese equities in your fund, I mean, how do you talk to investors at the moment, and especially after having seen the significant sell-off over the course of last year with many Chinese stocks off by some 25%?
Well, look, we've been running Chinese fund for a very long time, and pretty much every quarterly and monthly we talk about the volatility in the asset class, so we hope our clients are used to it. But we have a very clear strategy at the moment. In a time when China is not growing particularly strongly, and when there's a lot of change in terms of reform, you really need to be only in the best companies, and you need to be in the most robust industries that are generating cash flow, have high margins, and very importantly, don't have any debt. So, you certainly wouldn't see us be buying into particularly any of these reform stories on the supply side with regard to steel or coal or anything like that. It's going to be extremely messy in those industries, and I would steer clear of them. Where I would be targeting is industries and companies operating in consumer services, particularly those around IT. And in this sell-off, I wouldn't be dipping my toes in poor quality companies. I would be buying good quality companies, companies like Tencent, companies like AIA.
Sure.
Those are in the consumer space.
But it's fair to say, though, that there's pretty heavy deleveraging still taking place in a lot of the more traditional sectors?
Oh, absolutely. They're struggling for cash flow, let alone paying off some of their debt. So, steel prices are going up, actually, in Shanghai. Bao Steel's been raising prices. So you might see some analysts increase their profit estimates for the company based on the spread over iron ore. But, wow, that's got a long way to go to address the balance sheets across the whole of the steel sector in China. So, that's definitely an avoid for us.